funny. We're gonna go ahead and get started. Welcome. Welcome, everyone. For those of you who don't know me, I'm Tanya Thomsen. I am with the Thomsen team here at Modern Realty Partners. And thank you for joining us. We have some amazing investment experts with us today who are willing to share all their knowledge and experience with you. So our agenda for the evening, we've got 2 hours. We'll do a few quick little introductions. Then we're going to talk about legal considerations, calculating return on investment, and then some of the basics of real estate investing. This is intended to be interactive. So please make sure that if you have questions, ask them. On the Zoom, we have someone monitoring, so you can put questions in the chat, you can raise your hand, whatever you'd like, and our monitor will make sure that the speaker sees your question, and they can also see you when you start talking as well. All right. Any questions right now? Okay.
We had a couple more join in on Zoom.
We had a couple more join in. Yay, welcome.
I think that's who you were maybe waiting for.
We do have a handout for the attorney's part because it's all in really small type and it's many slides long. So we have a handout, and then we're also going to email you an electronic version because it has live links in it to take you to some of the websites that he's referencing.
Does everybody have the handout in here?
No, I don't have those things. Okay.
I will do that.
All right. So this evening, our attorney is Matt Krawcheck. He is going to kick us off, and he has a lot of experience as an attorney, but he's also the broker, a co-broker owner of Modern Realty Partners. Then after that, Miranda Zieg, who's a very experienced realtor and investor, will jump in, and then Aaron Zieg and John Warren are some lenders who are very active in investments, and they'll jump in. So, Matt,
right.
take it away.
Thank you very much. Thank you, Tanya. Again, I'm attorney Matt Krawcheck from the law firm of Krawcheck, Ginsky and Rohr. I'm also broker owner here at Modern Realty Partners, and I'm going to talk briefly about LLCs and real estate and kind of the interplay between the two. I mean, an LLC basically is a limited liability company, and it is meant to protect your individual assets as it relates to any activities you might have from a real estate investing perspective. So
Is there slides that you need the clicker for?
Yeah.
it's just they're just notes. I mean, the main thing is just, yeah, the main thing is, and in the materials that you'll receive, there are links to a lot of these resources. What I've included in here is links directly to a lot of things I'm talking about. If you're going to go set up an LLC, there's a link directly to the Wisconsin Department of Financial Institutions website. So it makes it very easy to follow kind of where I'm directing you, because at the end of the day, it's pretty easy to set up an LLC on your own. It takes about 15 minutes to a half hour. So if you go through these slides and go through the FAQs, it'll really help you in that process. And if there's any questions, you're always free to reach out to me or call me or email, and I'm happy to help in that regard, but it doesn't take a long time. So I figured we focus first on, how do you set up an LLC? You go to the Wisconsin Department of Financial Institutions website, go right to the link that I have in here, related to that, what you need and directions, and it goes through all the information that you need. You need a name for the entity. So the first thing you're going to want to do is write a couple names down and then hop on there and do a business entity search and see if that name is already taken. And you'll want the LLC portion should be included in the name. So anyone who is seeing anything or doing business with that entity knows that they're doing business with an LLC. So I like to put comma LLC at the end of the name. So that way I know every single one. I have the comma in there before the LLC, but that's just my own little attorney OCD thing, I guess. But it's very helpful. Name, registered agent. That registered agent is who's going to accept service or legal documents or other, like your annual report reminder, because you need to file an annual report every year with your LLC. And there are entities that will act on your behalf for that, but you need someone with a presence in Wisconsin for that. Sometimes our law firm will act as a registered agent. Otherwise, you have like Northwest registered agent. I think I have a link to that in here, and CT Corporation, which can act as a registered agent. You also need a principal office. Some of my clients, they don't love to have their home address out online from a privacy standpoint, so they will sometimes opt for a PO box, but it's getting more difficult to have a PO box as your principal office. So if you're going to be buying real estate, you can always put the address of the real estate as that office address, right? If you're going to put real estate into an entity, you can also use that address for that. And sometimes use a PO box as a placeholder until you close then on that real estate and have that real estate in that entity name. And then the other information there, organizer and drafter, that's generally if I'm the one completing the LLC documentation for you to create it, I would be the organizer and drafter. If you're going onto the website and doing it directly, then you would put that as you're the organizer and the drafter of that document. And then you put your signature and it's a $130 fee to set up the LLC. So all in all, 15 minutes to a half hour to complete that. From there, then, once that you'll receive a filed confirmation from the state of Wisconsin, which will be your articles of organization. So if you're a single member, meaning you're the only one who owns any interest in the LLC, you will receive those articles of organization. You don't really need to do an operating agreement in addition to that if you're a single member. If you're a multi-member and you're investing with other parties in this real estate, then I would recommend taking that additional step and having an attorney draft an operating agreement for that entity. And that operating agreement will define, you know, in certain circumstances, what happens related to the LLC. If someone were to die, if someone were to get divorced, it kind of goes through, it's usually about 20 or 30 pages, goes through a lot of those different circumstances. So if you're going to be having multiple members that own the LLC and own the real estate, I would highly recommend having an operating agreement drafted. If you're a single member, you don't really need one. So any questions? So that if there's any questions, feel free to chime in as we go along. The next portion is then from there, you'll want to go into the IRS link that I have in there, which is to get an employer identification number. And the EIN, again, doesn't take long to apply for. And once you get that, that'll give you what you need to set up a bank account and then touch base with your accountant, with your EIN, your articles of organization, because with your accountant, you'll want, depending on what you're using the LLC for, you might decide you want to make an S corp election for tax purposes related to the LLC. So that's just something you'll want to touch base with your accountant on. The other item that you'd want then is to touch base with your insurance person as far as how you're operating that LLC, making sure you have liability insurance riders on any policies that you have related to that LLC. So those are just kind of the high level basics when you're setting up an LLC. As it relates to real estate, generally, and this depends on kind of how much real estate you acquire, is when you start out, if you want to put the entity, the real estate in the one entity, that's fine. And as that entity then starts leasing out to, or you're leasing that entity or that real estate out to tenants, you might want to consider a separate entity for which is like your operating LLC. Because if something were to happen with the tenants and that LLC, if they can potentially get at the equity in that real estate, if there's an issue, like let's say you don't understand a certain rule as you're leasing out that property to a tenant, right? And there's an issue that arises and that tenant ultimately sues the entity, which is the leasing entity to that tenant. If the entity holds both the real estate and is the one on the lease documentation, the equity in that real estate could be an asset that that party could collect against. So a lot of our clients now, as they acquire more real estate, will put the property in an LLC and then have a separate operating entity. So you might have ABC Real Estate LLC and then ABC Operating LLC as the rental operating entity. So yes.
Do you need a different operating LLC for each LLC?
No, you have one. So what generally happens is, and that's a good question. Let's say you acquired 20 properties, right? You still can use ABC Operating, kind of like a property manager, right? ABC Operating is on all the leases. That is your operating entity. It doesn't have any assets, doesn't hold any real estate, but it does have a liability insurance policy, right? If anything were to happen, you have sufficient insurance, and that is really the main recovery item if something were to happen and a tenant sues that entity, right? But if you have 20 properties, you can do multiple things. You can have one LLC and a different LLC in all 20 properties, but that can get very voluminous, can get expenses. You're paying $130 per LLC. You're paying I think it's $30 a year to do annual reports for each one of those LLCs. So what a lot of our clients have done is kind of cluster them, where they'll do maybe 3 or 4 properties in LLC cluster 1, 3 or 4 properties in LLC cluster 2, 3 or 4 properties in LLC cluster 3, and then at least there's some separation there. but you don't have 20 different LLCs where you have, so much documentation, you have K1s for each one of those, it can get just really overkill, right? From a liability layering perspective. So usually you'll have ABC operating, that'll be the entity that's on all the leases for all 20 of those properties. So if you sign a 12-month lease, ABC operating will be on that lease and any other leases. And then ABC holding, it will be the owner of the property. So that's why it's very important when as you start setting this up, like I said, to connect with an accountant, connect with an insurance agent, because you can do all the right things setting up LLCs, but if you set up one bank account and you start commingling all the funds as though it's one LLC, all of what you did from a legal perspective, it's not going to matter because you're treating it as though it's one entity. So you have to get those separate LLCs, get separate EINs, and treat them separately from a bank account perspective, right? Keep the operating expenses in ABC operating, and then the mortgage payments, property insurance, property tax payments in those separate accounts for those properties with those LLCs. Does that make sense? So that is kind of an overview there on how a lot of our clients do it. Yes.
And you also would suggest that your personal banking account should not be at the same bank as your LLC account.
It can be as long as you're keeping those expenses, but if you want to make it easier, then using a different bank would probably be helpful. But if you have a good relationship, you can have a personal account there. You just have to make sure you're depositing things correctly in the commercial account versus the personal account. But if it's easier, then yes, using a completely separate bank, so you know that this is who I'm using for commercial, this is my personal, that just keeping those separate is very important. Otherwise, the LLC layering won't really help you because you're treating it as though it's all commingled in one. But that is a good point. Any other questions?
How about umbrella policies, in tying to LLCs? If you have multiple clusters, is
Yeah.
that sufficiently effective, or is it more or less an umbrella policy by property?
If you're the single member of all those LLCs, right, you own all of them, so there's a commonality of ownership between all of them, then you can typically get a rider on your personal umbrella, right? Like for those, because you're a single member throughout them. If you have different investors in different LLCs, maybe these partners are with me in these clusters and these partners are with these, then it gets more difficult, right? Because they don't have commonality amongst all of them. So if you're an investor and you own all these LLCs yourself, then typically you can get an umbrella where it's not as complex because these entities are seen from tax purposes as disregarded entities because you're the single member. So a lot of times, that's why I think it's important to talk to your insurance agent and talk through these. Hey, look, I'm the owner throughout all these. Can I just have a rider added to the umbrella that I already have in the existence for a lot of these? Because I'm the single member, and a lot of times you can't. So I've got other resources then from going from that kind of investing. I have the duties reference that you need to be aware of, like we talked about the operating agreement. If you're a member of an LLC, you have a duty of care, you have a duty of loyalty, duty of good faith and fair dealing, just being cognizant of that, especially when you have multiple members. And when you're a single member, it's not as concerning. You're just answering yourself. But you have different investors in there. You got to remember those duties. And that operating agreement is very important, defining who's going to be the manager, what are the roles and responsibilities for everyone. Maybe other people are bringing more money up to purchase the property, and others are going to do more from a services standpoint. The operating agreement helps kind of define that and what the capital accounts look like. So from there, then I have resources about once you actually transition into becoming a landlord, what does that entail? Wisconsin Legal Blank, attorney Tristan Pettit does a really good job of having packets. Those links will take you right to like the landlord packet, where all rental forms, he does a very good job of updating those forms. They have landlord packets that you can you look on their website, purchase. They're very cost effective, a lot more cost effective than calling me and having me do it at $395 an hour versus what they'll be able to do. It's a very good resource, and I direct a lot of my residential tenant clients or landlord clients to that packet. So I highly recommend looking at that link and kind of going through all those forms, because there are a lot of technical requirements as a landlord, and going through then if you ultimately have to evict someone, making sure the notices are correct, the 5-day, the 14-day, the 28-day, and month-to-month and service and all those things. So there's a lot of great resources. There's I think I have the self-help in here as well. And the landlord training, which is actually free. Milwaukee will do, I think it's a 5-hour course where it's a free landlord training. So they do a very good job. There's a lot of resources out there that can really help and are very cost effective to learning how that landlord tenant process works. From there, something that is new that you have to be aware of if you do set up an LLC now is the Corporate Transparency Act. And there is litigation, there's active litigation on this right now, in Alabama. A judge just, I think it was last week, that's temporarily stayed this, but only as to the plaintiffs in that case. So this is a fluid situation, but right now these requirements, and I think the government just appealed or today or yesterday. But right now these requirements are still here. So if you have any existing LLCs before 2024, then you have to comply with this act by 1/1/25. And what does this act require? It requires the name of the entity, any owners of that entity, which is 25% or more, or if you have substantial control, which hasn't really been defined yet. But effectively, it's a list with the government of it's an anti-money laundering act, where it's a list with the government where they want additional information related to any of these LLCs. Bigger companies are exempt. But holding an LLC, all of these I have hundreds of these to do here this year for clients. But it's something you have to be aware of. So if you create a new LLC in 2024, you have 90 days from creating that LLC to comply with this act. If you had one from before 2024, you've got till 1/1/25. Anything created 1/1/25 or later, you only have 30 days to comply. So I have links in my materials directly to where you need to go. It's a simple form to fill out. I'm doing these for a lot of my clients, always happy to answer any questions or assist as well on this. But it's something you definitely need to be aware of. The penalties are significant. There's criminal penalties, there's civil penalties, $10,000, 2 years in jail, and I think $500 fines per day. So now, whether or not they'd actually think there'll be some leniency here, but I mean, those penalties are significant. So I've got links to everything in here on where you need to go. There's all the links on the information. And it's a simple, the reporting link is very, very easy. It's pretty much name, date of birth, address, and then you have to give an image of your license or passport to show the ID number that you're using. And the main thing that a lot of people think, okay, once I fill this out, I'm done. Well, no, if any of that information changes, like you change or update an address, this has to be updated with FinCEN, and that has to be kept updated. So that is everything I have. If there's any questions, let me know. And I'm always happy to answer any questions. Tanya, if anyone reaches out, any information they have, feel free to reach out.
Awesome.
Okay.
Thank you, Matt. Like, as I mentioned earlier, we'll email all of you the documents that we have here, people on hand, everyone on Zoom will get it. And then those are live links. So you can click on those. Do you guys want to sit at the table? Will that be more comfortable? No, you're okay? All right. Okay, Miranda's next. Yay.
All right, fun. Okay. Oh, let's just make sure I'm in the frame here. Okay, hi everyone. I'm Miranda Zieg. I'm also with Tanya's team here at Modern Realty Partners. So I've been a realtor for 10 years, but investing in real estate with my husband prior to that. So one of the first things we're going to talk about, and yes, I just want to piggyback off of what Matt said, is that I did go for the free landlord training through Milwaukee. It's one Saturday afternoon. I think it's 4 hours, but a lot of great information there. And you get this massive book that you can use when you've got questions coming up. And also too, I get all of my leases from Wisconsin Legal Blank, and they're very, very inexpensive. So, but okay. So starting out with a lot of you, this is like you're thinking about getting into real estate investing and not sure how it works. So we're going to talk about ROI, which is return on investment, and how to calculate it. Because as you're working with us on like, hey, do I want to go take a look at this property? While it might seem all shiny and new, the numbers are what matter. Because at the end of the day, this is a property you're likely not living in. What matters to you is, do the numbers make sense? Like, it's a business decision, not an emotional decision. And so right here on the slide, we're talking about the basic calculation. What you're taking is the monthly rent minus your monthly expenses. Now that's going to give you your monthly profit. Let's hope. If that is already negative, that is not good. So now you're going to take your positive monthly profit. Now we're going to times it by 12. to get what your yearly profit is. Now you're gonna take that number and divide it by your initial investment, and that's gonna give you your percentage of ROI. So what we're looking at is, well, is this gonna be 5%, 10%, 20%? What is it? And everyone has their different risk tolerances of what they think is a good ROI. Me personally, it depends on the property. So if the property needs work, I already need, so I don't know if there's any Robert Kiyosaki fans, Rich Dad, Poor Dad out there. He will say in real estate investing, Aaron's probably gonna say this later, but make your money on the front end. So if it needs work, that means you have to put more money into it, which also goes into these calculations. So you want to make sure that that percentage is higher. I will go lower if everything else seems to be really well, but we'll talk about that here in a second. So first slide here, these are actual real life sales that were last year. And I just picked duplexes to start with. So in this first example, we have a duplex that was purchased at $360,000. Now, these numbers depending, your rate is going to be dependent on, of course, the price point, your credit score, so all things that they'll kind of talk about. But I just took the payment at 7.75% APR. And as an investor, your rates are a little higher than if you're going to be owner occupant. So now as an investor, you have to put down 25% on a duplex. So that's $90,000. The taxes on this property is $6,107. And I estimated for the duplex about $1,200 for insurance for the year. Now, insurance costs are going up. So that's going to be definitely a question for your insurance agent to kind of get some of those numbers a little bit ahead of time. So right now, what we're looking at is you can kind of, oh shoot, I can't move too far. Okay, so there's on the MLS, which is our multiple listing service that shows all the information about it. It actually shows you what the rents are on here. So one unit is $1,125, the other one is $860. So your rents equal $2,300. Now, already calculating what your mortgage payment is going to be, and that's going to include your taxes and insurance, you're at $25.43.23. So your payment is over your monthly rents. This is why I'm going to call this as a bad buy.
One of the problems I think people have is that you own an income property, you get to know the tenants, and it's a nice relationship, and you don't keep rents at market level. You could see that example very easily in any type of investment where you want to evaluate, are the rents calibrated to the current market rate?
Right.
If they're not, obviously that does throw a little bit of a swag in that formula.
Right.
Can you repeat what he said so the Zoom
Oh,
people can?
did everyone on Zoom hear that, or do you want me to repeat what was said? Okay, anyway, so he's talking about, and I was going to go into that next, but yes, what the point is like right now on paper, this is a bad investment because we also haven't calculated in your utilities, but this property might not be at market rents. So what that means is that these rents have been, like these tenants have been there long term. They have not, like when the owner purchased this property, they probably purchased it for much lower at that time, and this kept the rents the same. So those are things we also will factor in and look at is, can these rents be raised to make these numbers make sense? Now, if we find out that these are market rents, then of course being in the negative is not a good thing. So this would not be something you would want to look at. But if it's currently something where, okay, they just have been there for a really long time, the owner's been really nice to them, what can we actually get it for? And will that give me positive cash flow? Then yes, that'd be something to consider to look at. Makes sense? All right. Oh, I've got the clicker. Okay, so in this second example, this one we are going to so on here again, purchase price of $170. What we're looking at is the fixed interest rate of 7.75. Now 25% down on this is $42,500. Taxes on the property was $2,816. I was estimating insurance of $1,200. Now your total monthly payment, including taxes and insurance right now is $1,248.09. So those are your, just those basic expenses that you have. And the monthly rents are $1,850. Now, what other expenses would we possibly have with this property?
Mostly you got general maintenance, lawn, snow, I mean, if you're not doing that yourself.
Water and sewer.
So water and sewer is the one that I'm going to include in this one. With a duplex, is it easier to get your tenants to do snow removal and lawn care, write that into their lease? Absolutely. If you're buying a 4-unit, those are other expenses you might look at is then going to be your lawn care, your snow removal, because you might not be able to get a tenant to do that. And also if there's a dumpster that needs to be there, that might be another additional cost. Also, if you don't want to manage them yourselves and you want to have a property management company, that's also an expense you want to include in your calculations. But for this example, what I did is, let me just use the board here. Okay, oh,
We're running.
not use that marker, okay. All right, so in this example here, I'm going to tack on water. So what I generally do is think about how many bedrooms are there and what kind of, like, how much usage is gonna be. So I like to calculate at least $75 a month per unit, so 150. So that now brings, like, let's say everything is clean here, no repairs are needed, and like you can just buy this, everything's great as it's going, and you're gonna manage it yourself. Now with 150, your total expenses are $1398.09. I should probably write bigger. Yes. Okay.
Big one.
All right. So we had 18.
Oh, that one's not working, is it? Here, you try this.
Any of that work? All right. Let me try that one. Oh, here. I can't put the key up on. That's all right. So we got 1850 minus 1398.09. So now your monthly profit is $451.91. So multiplying that by 12, that puts you at $5,422.92 for the year. But now we have to look at what was put down, 42,000. So we're taking 5,422.92 divided by 42,500, which puts us at 12.75% ROI on this property. Now, like I said, everyone's different. This would be something I would consider a good investment if everything is clean. You don't have to stick like 20 grand into it right away, because if you got to put 20 grand into it, then you got to add that into here, which then lowers it. But the guys who are next are going to talk about why this number is not just this, and long-term keeping it with appreciation and debt reduction because your renters are paying down your debt, how that also factors into your return on investment. So I will now turn it over to them. Do you need the board?
No.
Do you want me to read it? You will? Well,
Anyone have any questions on that so far?
oh yeah, any questions? Oh, clicker, I don't know, here it is.
Do you take write-offs into consideration?
That will all be talked about. Yep,
Awesome question.
I will leave it to that one.
Those are called paid transitions, everyone.
No, go ahead, sorry.
No, it's not.
Go ahead, you start.
All right. Hi, everyone. My name is Aaron Zieg, and I'm with A+ Mortgage. But to give a little more background, I've been investing in real estate, investing specifically with Miranda actually for going on 12 to 13 years now. We currently have 6 properties outside of what we live in that total 14 rental units. We've had a few others that we've turned over the years, bought and sold. We've owned a vacation rental up north. We've owned a mobile home park up north. And all of our current rentals are either in the Milwaukee or Watertown area. So I want to touch on here why invest in real estate. And on the lending side, both my partner, John, who you're going to talk to here in a little bit, and myself, we work with a ton of real estate investors. And then also on the personal side, we talk to a ton of real estate investors, even if we're not working directly together. So we're going to dive into some strategies here, but every time, whether it's a new investor, whether it's somebody buying their 35th property, which yes, we know those too, those clients as well. The reasons are always a little bit different, but they always come down to something fairly similar. we either hear things like, I want to retire early. I want to build wealth and leave a legacy for my family. I want to put the kids through college and not have to be strained. I want to have, maybe you're like me, where I don't really think I'm going to ever fully retire. I'll retire early, but never fully be done, if that makes sense. But in my mind, I want an expanded retirement. I want to be able to travel more. Then maybe there's other things you want to do. We're going to go into how real estate investing can help you with all of these. So my segment initially here is going to be really going into breaking down buying the property and holding it. So we're going to start here, and on your screen, you should see the fourth wealth building benefits of real estate. These 4 quadrants, I want you to know them so extremely well that at some point in the next week, you could be sitting at a coffee shop or with somebody at work, and you could be drawing this on the back of a napkin. Because we're going to really build up the full ROI, both initially and then compound this over years as to how this is going to help your dreams come true. Any guesses? How many millionaires on average are made in real estate?
Most millionaires are making real estate.
Most, and that's a very accurate answer, 90%, to be exact, the most recent statistic. So whatever your why is, we're going to go into that, and we're going to show you exactly how this works here. So Miranda broke down on the top left quadrant, cash flow, how to break down our ROI and cash flow. We're going to start there first. And yes, I am going to quote Robert Kiyosaki, Rich Dad, Poor Dad. I want you to get that ingrained in your head. His number 1 rule is make your money on the front end. Don't get a bad buy. All the seminars he's ever done, I've read many of his books. I've heard him talk. There's many other real estate books I've read as well. Everybody I've ever talked to that says, oh, it's a bad buy, you're going to get burned. They skipped rule number 1. If you break down Miranda's strategy in the front end of how to break down your ROI, you take what John mentioned in our audience here, and John, our other presenter, is going to touch us on this a little more of making sure you get your market rents right. Make your money in the front end, get your cash flow right. Now, if the market tanks tomorrow, guess what? I don't care. I'm not selling it tomorrow. I plan on having this property for 10, 15, 20 years. If it tanks tomorrow, guess what? I get to buy more property. I'm happy. And if it doesn't, well, then I'm going to make more money in the other quadrants. I'm still happy. So let's go into cash flow here. We're going to use a couple of assumptions. Miranda broke down a very realistic example in just the last year based on actual rate and actual purchase price of a 12.7% ROI. We're going to lower that a little bit because I know some of you might be thinking, well, maybe that's not realistic. Maybe I'm not going to find that. We're going to go off 10% ROI. We're going to use in this assumptive example a $300,000 purchase price. We're going to use conventional financing, which means you're coming with 25% down. That's $75,000. So if we take, based on Miranda's formula, 10% ROI on that $75,000 that we're walking to the table with, we are making $7,500 in year number 1. But if anybody's watched the rental market, and this echoes John's point again, rents are going up each year. They've actually gone up quite dramatically over the last 5 years. But again, we're going to go really safe. We're going to say they're just going up 3.5% per year. All right, if I do that, I've made $7,500 in year 1. Great. Some of you might be thinking that's what I can make in the stock market. Well, as this compounds and our rent grows year over year, let's compound this over 10 years. In 10 years, this is actually compounded to $124,000 just in cash flow, based on just rent increasing by 3.5% a year. So I walked in with $75,000. I walked out just in the cash flow side alone with $124,000 using very, very safe assumptive numbers here, actually safe on the low end. Now let's go into appreciation. For anybody that owns a home right now, if you've looked online, if you bought it 3 years ago, 5 years ago, 10 years ago, you're remembering what you bought your home for, and you're looking online, or you're talking to Tanya, Miranda, Crystal, other members on the team, and you're like, holy crap, is that really what my house is worth now? And the answer is probably yes. And if you're hearing from them, almost certainly yes. So homes are appreciating. As a matter of fact, they've been appreciating close to double digits now for going on 5 years per year. However, we're using just 3.5% a year. So we're going extremely safe. We're going about a third from what they've actually been over the last 5 years. So we're factoring in, for those of you who might be thinking, what about 07, 08, 09, 10 when the market crashed? We're factoring in the highs, the lows, and we're actually still going below historic average, which I'll touch on here. Well, based on that, over 10 years, that $300,000 purchase 10 years from now, if I sell it, just based on 3.5% a year, which again is very low and safe, we're now able to sell it for at least $423,000. We made $123,000. All right, let's go to mortgage reduction. Over that 10 years, I'm using other people's money to finance this mortgage. I'm taking a loan on it. Maybe I'm even leveraging equity, which we do a lot, and John's going to touch on this more. We do a home equity line of credit on our home. We take that equity, we buy our rental properties. Some people have said to me, Aaron, you're lucky. We don't have that money sitting around. Neither do we. We don't either. But we leverage the equity in our home. We bought 2 to 3 properties a year with that equity. And guess what? In 10 years, now our renters are paying our mortgage for us. Plus we're making the cash flow on it. Plus it's appreciating. And in 10 years, if I don't make any additional overage payments, another $36,000 got paid off in that mortgage. Let's add these 3 up because tax savings, we're going to come back to later. That's going to be a whole separate segment today. But just these 3 alone. Now remember, we walked into the table with $75,000 of your own money somehow, some way. Maybe you leveraged your money from your home equity line of credit. Maybe you had that money aside. But adding this all up in 10 years, this one property turned into $283,000 in additional money in your pocket. All in. That is a 378% return. That is absolutely incredible. I've now been in this game for going on 12 to 13 years. I remember when my mentor 12 to 13 years ago talked to me about this kind of stuff, and I was nervous, and he said the hardest step is to take the first step. And it took us a couple of years. We dragged our feet, and then we did so. And then we bought a second one, and now, we've got 6. We've had a couple others along the way. But the biggest point I want to make here is we've seen that 10 years in action. We've seen how this takes effect. So this is just one property. Some of you are saying, hey, Aaron, $283,000 isn't $1 million, though. It's a great number. Don't get me wrong, but it's not $1 million. And you said 90% of millionaires are made in real estate. All right. Well, let's say you buy your first one. You take that hard first step. We're going to compound that over. Let's say you start to buy one every 2 to 3 years here. But before we go into that, I want to touch on appreciation once more. I mentioned we're only using a 3.5% appreciation rate. If we go all the way back to 1987 through the end of this past year, the average of that very, very long 36-year period is 4.8% a year. That takes in some of the downs at the end of the 80s. That takes in 2007 through 2012 into account. So it's not just looking at the up years. So that 3.5% that we're using is very safe. It's actually underestimating this. That 283,000 I'm walking away with on that one property is actually low. Or maybe something happens. Maybe I have more vacancies that I plan on. Maybe I have to do some fixes. Okay, I'll make it up in higher appreciation in all reality. All right, so now we're going to do a 20-year example. Let's say a couple of you within the next 6 months to a year make that very difficult first step. And now let's say you're like, you know what, this is great. We're going to do that approach. We're going to buy one of these every 2 years for 10 years. So 10 years from now, you're going to have 5 properties purchased. We're going to do a few different assumptions here. So I mentioned first point already, one property purchased every other year for 10 years. We're going to use the average price that we already went over in my last example of 300,000 just to keep things simple and consistent here. We're going to use the cash on cash ROI. So that's the cash flow ROI that I talked about that Miranda broke down for us of 10%, going very safe again. We're going to do a 25% down payment. So again, that's a $75,000. We're going to amortize the loan over 30 years. So we're doing a 30-year fixed conventional loan. And we're going to estimate when we ran these numbers that rent is not only going up 3.5% a year as mentioned earlier, but expenses are going up 3.5% a year. We're not naive to the fact that expenses and fixes have gone up. But we're also gonna say again that appreciation is going 3.5%, even though I just showed you historically for 36 years, it's actually 4.8%. And we're also gonna factor in a vacancy rate of 5%. That means over once every 2 years, each unit we're factoring in is gonna have a vacancy. So we're really trying to be safe with all of these numbers here. All right, let's have some fun because there is a true compound effect when it comes to investing in general and real estate investing. It freaking skyrockets. Oh, and we also factored in an extra $2,000 a year per property, just an additional capital expenditures on top of that. Almost missed that one. All right, so over 20 years, again, buying a property every other year for the first 10 and just letting them ride. In 20 years, with rent going up 3.5% per year, my cash flow has now accumulated based on all of those assumptions, $1.4 million, $1.339 million, excuse me. Now we're getting to that millionaire category. All right, how much of my mortgage has gotten paid down? Because the longer the mortgage goes, more goes off the principal, less goes off the interest. All right, we've now paid off 1.1 million, just a little over. How about appreciation based on just that measly little 3.5% a year average? Oh, that's up to 356. That's not even correct. There's no way. Something was typed in wrong on my part. I will own that on my end. But long story short, in 20 years, we've accumulated $2.8 million. Now, let's say we're really wrong. We had a bunch of fixes and a bunch more vacancies, and we're only at 2 million. Are you okay with that? I think you'll be okay. Let's look at year 20 alone, because again, this is where the compound effect kicks in. Let's talk about that early retirement or an expanded and enhanced retirement or leaving the legacy. Year number 20 alone, with 3.5% increase in rents, we're going to make $134,000 based on those five properties in year number 20 alone. The amount of debt getting paid down between those 5 mortgages in year number 20 alone is almost $90,000. The total appreciation in year number 20 alone is an additional $35,000. And our net worth grew that year, if we calculate these numbers together, by over $250,000 just in year 20 alone. This isn't touching your 401ks. This isn't touching your Roth IRAs or IRAs. It's not touching any of your other investments. This is what we're calling wealth building right here. Key takeaway: to buy those 5 properties, we came in with $375,000. Yes, that's a big chunk of change, but many of you might have that already in your home equity. Others of you maybe want to borrow some against your 401k. Others maybe have a rainy day fund. Wherever it's coming from, maybe you have enough for 1 or 2 in the next year or 2. You get your feet under you, and then over time, your property continues to grow and you expand that home equity line. There's ways for this to happen. You'll hear John's story a little bit as well, but that $375,000 turned into $2.8 million in 20 years. That's a 750% return using very safe, conservative numbers. We haven't even gotten into the tax savings yet. That's called winning. We're going to stop here. I'm going to introduce my partner, John Warren, in a moment. Any questions? Either
Factor depreciation into all this.
we're going to save that for the tax segment. Awesome question. So the question was, how do we factor depreciation into it? Depreciation is a huge element to the tax savings side of this. That's forecasting for later on. We're going to have a whole 2 slides just on that alone. So awesome. Love that. Any other questions, either on Zoom or in person here?
So if you take out a home equity loan to buy a property, you factor that into the calculation as well?
Personally, I don't, because I look at it as if I took a home equity line of credit and let's say I'm using that to buy Bitcoin when it before it skyrocketed up again, or to put it into the stock market or whatever I'm using it for. If I took it out to put an expansion on my house, I'm not necessarily going, well, it's a double hit on what I expanded on now because I'm factoring that in as well. So I look at it as it's just a separate side loan. However, that does go back to rule number 1. I mean, I'll be honest, we've maxed out our home equity line 2 and almost 3 times now when we've added properties. And then our goal is how do we pay it off as quickly as possible, but it gets very, very motivating. We find ways, at least we did, to be like, okay, can we cut out going out for coffee on a daily basis? Is building another $250,000 to the net worth in the next 10 years worth cutting coffee? Yeah, to me it is. I can make my coffee at home. So now that money goes towards paying down the home equity line. Basically, can we find ways to live off this portion of the income and pay that down, and then the money we're making on the properties, the investment properties, is also paying the home equity line down. But great question. We don't factor it in. You certainly could. We had another question coming over here.
Exact same question.
Two are too close. You got the wavelength thing going.
I'm scared.
Any other questions online, Brian, that came through? All right, without further ado, I'm going to introduce John Warren, my business partner.
Good evening, everyone. Unlike Aaron, I need my $6 caffeine in the morning. Because otherwise performance goes down and then money goes down and snowball effect. So my name's John Warren. Aaron is my business partner. I'm a lender with A+ Mortgage. But I wanted to give some personal context to my portfolio and background, and then kind of share my own personal insights that I've acquired along the way of being an investor. So currently I own 19 units. I'm under contract to buy one more duplex here in West Dallas on 110th and Cleveland. I started my investment journey back in 2012. I was flipping homes, and a buddy of mine really liked the house that I had for sale. And so he's like, hey, I can't get financing, but I can trade some properties. So he gave me 3 properties in not the best parts of town, like 6th and Beecher, 11th and Burnham. If you're familiar, at that time, properties were selling for about $20,000 to $30,000 a piece. So I got 3 of those. He gave me a gold chain worth $2,000 because I used to like buy and sell gold and silver. And he gave me a 1939 Chevy cab over engine that was like rat rod style, and 20 grand cash. And then we did a land contract for about 15 grand. So very fascinating story, but that was my entry point to real estate. Now, I bought these properties sight unseen. I didn't even drive by them. I just called up my agent friend, who was Troy at the time, and I said, hey, here's what's going on. Do I walk from this or do I take these properties? I was like uncomfortable because not the best parts of town, etc. And he's like, well, what are the numbers? Right? Do they make money? And we went through the numbers, and at that time rent was like $600, but they still cash flowed because there was no loan, right? And taxes were cheap. They were like $800 a year cheap. Even right now, I think they're like $1,500. So it's still super cheap. But that was my entry point to getting in real estate. And as Aaron mentioned before, the why of why we do everything is very important, even in investments, because it's what builds the strategy to fulfill our dreams and wishes, right? So when I was 25 years old, I was diagnosed with cancer. At that time, I was out of work for a few months, and guess what my only income was? My 3 slumlord properties, right? And that's when I realized, hey, this is pretty powerful stuff. Like, yes, it wasn't a lot of money. I was cash flowing maybe $400 per property. But $1,200 a month is a lot of money when you're not working, right? Like any money is good money when we're not working. So that's when I said, hey, I need to find ways to ramp up my game and get into more real estate, because my goal was this could happen to me again, right? I could get cancer, or so many things can happen that make it so we can no longer generate an income. And so I set a goal that I wanted $100,000 a year cash flow. So if anything were to ever happen, my family's secured. I didn't have any children when I had cancer, but I had 3 kids 5 years that followed that. So that's my why. My why is I want to not be a slave to my job in order to provide for the family. It was never to get rich quick. It was never to have millions of dollars, although that will be a consequence of it. It's all in the income strategy. So let me hit this slide here. When we're looking at property, like it's hard, right? We're starting out. What do we look for? How do we know we have a good deal? That's hard to say, right? When I called my agent for that $23,000 property in the not best part of Milwaukee, I didn't know, right? But he circled me to the numbers. So I want everybody to take a moment and think like a buyer and an investor here. This is a property I bought 2 years ago. It's in Milwaukee. It's right off of like 70th and Oklahoma. For anyone familiar, there's that like McDonald's right on the corner and that AMF. I think it's AMF Bowling, if it's still in existence, I don't
It's
know.
there.
So this is a picture of the exterior. This is a side by side. They're 2 bedroom, 1 bath apartments. They're about not even 1,000 square feet per side. I would say closer to 950 realistically, but when I advertise it, it's 1,000 because it sounds like a big number. So this is a photo of the front door when we come in, and here's kind of what the unit looks like. This is like standard, when you're looking at investment properties, what hits the market. Rarely are they totally renovated because we're not looking to pay top dollar, right? You got the 1960s kitchen, right? But it's clean and presentable. Some older appliances, we have standard tub, and we have hardwood floors throughout the unit. This was 2 years ago. But what do you think rent for 2 bedroom, 1 bath, 70th in Oklahoma, so Milwaukee area? What would you anticipate rent to be for a unit like this
2 years ago,
2 years ago?
750, 850.
Okay,
900?
No.
900,
1,100.
1100? What, you're going with 1100? Well, the landlord at the time had it rented for 850 to give some context. I'll get into some numbers, and I'll tell you I rented it for, but there's a huge spread, right? And if we don't have the right analysis and resource, which your resource is gonna be your agent, property manager, et cetera, because they're gonna tell you what rents are for that area. Because if you have the wrong rent number and you're doing your analysis, you're gonna see here at $900 a month, what happens for this unit. We have 2 units, right? So that gives us rent of $1,800 a month. Expenses for me on this property include mortgage, taxes, and insurance. I make the tenants pay water and snow removal. Like Miranda said, a lot of time with duplex, that's a very standard practice. So the cash flow number would be 426. That sounds like you're making money. But if we look at the return based on how Miranda showed us the calculation, we're making less than 2%. We're not even keeping up with the rate of inflation. To me, that looks like a terrifying number, right? I want to make money on my money, even if it is leveraged. Now, the ROI on cash, that's all relative. It looks amazing right there. And what ROI on cash is the amount of money you put in divided by the revenues you're getting. And that's gonna give you a number, or the revenue you get divided by the money you put in is gonna give you a percentage. Notice here, I only put 10% down. So if you have a teeny down payment, it will look like you have an infinite return, right? If I make $100 a month, but I put nothing down, what's my ROI? Infinite. So ROI, cash on cash, that's a relative figure and should never be our predominant focus, although it's one of my main focuses, but it should not be the only factor in a decision making because it's misleading. Because you're taking on a level of risk. So when we are in the marketplace, there's much different trading penny stocks and trading Apple stock, right? The returns look amazing for these penny stocks, but we're taking an incredible amount of risk. Likewise, when we put very little money down on a property, you're subject to more risk. You have bigger loans, etc. So as we walk through the example at $1,200 a month, we see that the ROI goes up to 4.5 and at 14, 6.3, and then we start seeing astronomical increases on that cash return, right? Well, when I advertise this for rent, I did get $1,400 a month. So if you're doing your analysis and we're using the 900, 1,100 or figures, we're off 33% minimum based on the $1,100 figure. So, and I had like 100 showings. Like it wasn't like just, I went for top dollar and I lost 6 months trying to get it. We put it up and it instantly went the first weekend. Today I'm renting it for $16.50, if you can imagine that, which I think is ridiculous. But if that's where the market is, it is important that you're keeping your rents going. So when we're looking at that, you're a buyer, right? What's your general tendency? You want a deal? I want a deal, right? Everybody wants a deal, but what goes into a deal? Normally, we're conservative. If I'm assessing that building, my tendency will always be, well, I'll be safe with this amount of rent. Because I'm trying to protect myself in the investment. But that's where we need to have those industry professionals to circle us back to reality, because if I would have passed on this deal, which I did consider, because I was using 950 as my analysis when I did it, because that's what was there already. And, you know, I don't want to pay for a building, have to get all these rents increased and do all the work and pay top dollar, right? No one wants to do that. However, if I'm looking with that 950 lens, I just passed up on a home run. Because as, I don't know, can I go back? Okay, if I passed up on it, I'm a cash flow investor. In fact, I don't even make decisions based on these. I'm looking at this and a percentage of this. To make $1,400 a month on one building and putting only $32,000 down to get it, I mean, you're literally getting your cash back in less than 2 years. Which means you could technically buy another one if you found a similar circumstance that every other year that Aaron was talking about. So it's super important that we have those right figures. Because otherwise we're gonna pass up deal after deal. And like, when I learned what I was leaving on the table, I realized how many home runs I passed up. Because let's just face it, anything you bought in 2018, 2019, 2020, they're all home runs now. So time in the market is huge. So I was gonna go a little bit into numbers, but since we already have a ton of numbers, you know, I wanna focus on the perspective of, okay, we saw a real life example of a property I own and the rents that I'm actually getting for that building. However, not all of us are equipped to even put 10% down on a property, right? So how do we make this a reality? And Aaron went over one strategy. When you already own a home, one of the beauties is we have had this year over year exceptional appreciation where you could buy a home in 2020 for 200,000 and it could be worth 300 to 350 today, which is, it hasn't happened in a very long time in the real estate market. I think like 40 years actually, looking at the appreciation charts. So that's one opportunity, right? We can use that home equity line of credit. That's great. But what if we don't have the house, right? What strategy can we do? Well, we can get our first time home buyer programs that allow us to do less down payment. So we have two different programs, right? We could get an FHA loan, which is a government-based loan that will allow you to put 3.5% down on 1 to 4 families. We also have conventional programs that will allow you to do as little as 5% down for 2 to 4 families.
This is living.
Living, this is all owner occupied. But if you don't own a home, house hacking is one of the best ways to start. One, you offset your mortgage and living expenses, so that will help you add up your savings, so you can buy that property in a few years. You know, if we're just starting out, it's not realistic to buy a property every other year. But once you get investing, it is very realistic to be able to do it every other year. So doing a conventional loan or FHA financing is a huge tool that you have. And even if you own a home, it's still possible to buy a 2 to 4 unit using one of those programs. But you are going to have to talk to your lender because there are certain obstacles once you own your first home. The property I showed you before, I actually did a seller financing option for that. And, you know, a lot of people think certain things aren't available just because the market's so competitive, moving crazy fast, etc. The reality is, if you put it out there, it returns to you. Every agent I know knows I'm always buying. I can't tell you how many deals I pass up on, anywhere from 1 to 300 deals I pass up on every year, because they call me and they say, hey, I have this. do you want it? And I just look at it, I run the numbers, if it doesn't meet my metrics, it moves on, right? And I only could buy so many a year, so since I'm getting so much deal flow, I can be a little pickier. But it all started because I told everyone I know that I'm always buying. So I'm the first person they think of because top of mind, right? Oh, hey, my grandma has to sell a house because she's moving into a nursing home. Well, I want to be top of mind to that friend because I can probably get a deal and actually help them transition by allowing grandma to stay there till they find a facility and giving them the cash they need to verify to move into a nursing home. So there's a lot of creativity and there's many sellers, like in this instance, where they're scared of tax consequences. Because once we own real estate for 40 years and fully depreciate it, and maybe we bought it for 100 grand like he did, and now we sold it for almost 300, there's some real tax liability there that actually would affect his pension or social security. I can't remember, but his tax accountant wanted him to juggle it. So what we did is we came up with a seller financing approach where we did what's called a land contract. And a land contract is basically where he still can take the property back if I don't meet the terms of paying him monthly to the terms we agree to. The benefit for him is he only pays taxes on the money I gave him that day. So the $230,000 loan or $40,000 loan that I still have, he's not paying taxes on that. There's no consequence until that's paid in full. And he needed to defer it for 5 years. So I have a 5-year balloon on that loan, meaning at the end of the 5-year term, I either got to refinance, pay him cash, I got to get out of that vehicle. But I've been presented over a dozen seller financing options in just the last 14 months. It's very real. It's just you have to be diligent in telling everybody what you're looking for. And then you got to set realistic expectations. Like there's no free lunch in life, right? So you're not going to find someone willing to sell you the property for a great discount, keep the financing of the home, and give you a 2% interest rate. You got to be realistic, right? Keep it in line with where banks are, but slightly less. Because if you're paying the same as the bank, you might as well go to the bank. And you can get into a lot more strategies, but if you're just starting out, super powerful strategy. I had 2 sellers last year that sold to the tenant that was there and they did a land contract. Actually 0 down in those cases because they just had a good relationship. So once you get a little bit bigger and you have multiple properties, commercial financing is pretty easy. You send 2 years tax returns. They don't verify bank statements or anything. They pretty much give you the loan as long as the property makes sense. So recap on the house hacking. Low down payments are available as low as 3.5% to 5% down, which is a huge opportunity to get you started. I always encourage everybody to buy as many units as they can afford. So if you can move into a 4-family to start, it's advantageous because you have 3 doors paying you instead of 1. So if you have a vacancy, it's not as painful as when you have a 2-unit property. Huge part of being a landlord is tenants. We have to deal with people, right? We're in the people business. A lot of people don't think owning real estate is people business, but it is. We're all humans. We all run into problems. Even when we look amazing on paper, things happen. Divorce, job changes, children, injuries, illness, sickness. We have to learn how to communicate and set expectations. And one of the big problems, and I think you mentioned it earlier, is sometimes you develop a friendship with these people because they are human and you're going over there and you say hi when you mow the lawn, etc. And sometimes that gets in our way of either our ability to collect rent when times are tough because we have empathy, we care, we're dealing with people, but also it prevents us from raising rents in many instances. And we can raise rent and be fair while being human, right? We don't have to be the landlord that raises the $200 just because we can, but we can do a 2 or 3% annual raise that might be $20, $30, which is very affordable. And then it keeps you going. The biggest downfall I see with a lot of landlords is they buy a building, they get a tenant, and if that tenant stays there, they don't raise the rent. So then when they're ready to raise the rent 5 years later, it is a $200 or $300 increase. And doesn't set you up for success, because turnovers, although turnover is an opportunity to increase rent, if you're creating the rent problem, now you're losing money because you're gonna lose half a month or a month, whatever that vacancy is gonna cost you. So when we're trying to attract quality tenants, we need to take the emotion out of this situation. So we need qualifiers, just like a mortgage, right? What do we look for with a mortgage? We review people's income. Because if they don't have income, how are they gonna pay their mortgage? I don't care if you have $1 million, the million can go away tomorrow. But income, as long as you have a job, we know that's gonna be recurring. Now, obviously, you could lose your job, et cetera, but that's more unknown than having money in the bank that can truly disappear. So we review income. For me, I wanna see 3 times rent. So if the rent is $1,000, we wanna see $3,000 a month for income of sorts, whether it's 1 or 2 people, it doesn't matter. We wanna check credit. What do lenders do? They pull your credit, right? What are we really looking for? 1, your credit score. 2, do you pay your bills on time? And 3, how much debt you have? Because let's take a tenant, for example, that has $3,000 a month income, right? They check the box of 3 times rent, but they have 3 car loans for $1,500 in total. I can bet you that tenant's gonna have a problem the first 6 months. He's either gonna get all those cars repoed or he's gonna stop paying your rent. So debt is something we always wanna consider in the equation. Lenders, generally speaking, never want debt to exceed 50% income. So if they make $3,000 a month, their total debt profile, including the rent, shouldn't be more than $1,500. Otherwise, they're just not set up for success. And why aren't they set up for success? Who has to buy food, right? Groceries are expensive. You gotta fill your gas tank. You gotta pay insurance. You have phone bills. You have the luxuries of life of going out to dinner occasionally. There's many things that consume our dollar, including taxes. So we wanna make sure that those debts are in line. The last part, and normally something I don't really care too much about, but it is important, is their assets. Lenders review it. From a tenant perspective, we at least wanna make sure they have enough money to pay our security deposit first month rent. We can't have an extremely high bar, because if every tenant had $20,000 in the bank, they probably wouldn't be seeking tenancy on a regular basis. They would probably be more in the category of looking to buy a home. So it's important that you set whatever metrics you want and are comfortable with for that income, which you can do your research on, but have parameters and guardrails so you don't make those emotional decisions. Because it's really easy when you meet someone and they're ready and you have a vacancy, your mission is to get that filled as quickly as possible. But a bad tenant costs a lot of money, a lot of money. It was in the court just for Milwaukee. I had to do my first eviction a year and a half ago. It takes typically 90 days. Because what they do is it takes 30 days to get the first court date. They show up with emergency aid, which costs them nothing. That buys them another 30 days. Then you finally get the eviction. Then you have to schedule with the sheriff to go there with the movers. By the time you get your building back, it's 3 months, because first you gotta send your notice. 30 days later, you get your court date. 30 days later, because they are gonna show up with an attorney, they will, it's free. They can go anywhere and get that. So before you know it, you're out 3 months rent. So bad tenants are very costly. So as much as we wanna fill those vacancies quickly, if we don't have parameters, we are setting those tenants up to fail, and we're setting ourselves up to fail, and it's very challenging. So that I'll go into the last part here. It may not always be perfect, but it's always worth it, right? We're gonna have vacancies. I kind of gave you my little eviction background there, right? That was on $2,000 a month rent, so that was $6,000 over that 90-day stretch. That's a big deal. But I've only had that once in 12 years of being a landlord. So like, although evictions happen, it is not as common as one might think unless you're not screening. And the tenant I had that happen with was an inherited tenant, which means they were there at the time of me acquiring the building. I have put new guardrails in place to try to re-qualify a tenant that's already in place to prevent that from happening in the future. But normally the issue is going to be with an inherited tenant because their loyalty was with the past landlord. So you have to find a way to reinstill that you're allowing them to stay there and have chosen them instead of frick this new guy, like it's a real deal. So yeah, you are gonna have economic downturns. We're gonna have COVID where you can't evict anybody. All these things happen, but at the end of the day, all business is risk. And as long as the income and the numbers make sense, you'll never lose. If your income and numbers don't make sense, you're set up for failure before you even started. And that's why Aaron goes over the numbers. He's talking about when cash flow makes sense, everything else makes sense because we're going to have the appreciation. We're going to have depreciation tax savings. We're going to have cash flow. But if we don't have cash flow, we have a real problem unless you're very rich or you're in a state where appreciation is obscene. Like, for example, California investors for a time there, they would buy a property for 400 grand in hopes to sell it for 500 2 years later. We don't have that level of appreciation here. And it's a high risk environment because the cash flow doesn't make sense. So when we're investors, we need to remove that emotion. And at the end, if we have time, I can share some horror stories that are kind of fun, just being a landlord, because reflecting back on them, it's always an experience, but know your numbers, set the metrics, make your own guardrails, protect yourself. We all know what our weaknesses are. So if it's the face-to-face contact, that's maybe when we need to hire a property manager because we can't disassociate that emotional connection. I think that's it for me.
One of the things you may want to be sensitive to if you're going to invest is you're looking at picking up an asset and it's a 4-family and the prior owner has given one of the tenants the authorization to run that complex. Now you go in and you want to basically manage that complex. They basically have a position of, I've been doing it this way for many years and this is how it runs. And you can have some challenges in there. I don't know if you've experienced that.
Not in the exact. Yeah, so his question is, when we have a tenant in a building that is given, let's say, property manager responsibilities to take care of the building, maybe at discounted rent, maybe they get paid for it. Everybody does it a little different. When you inherit that tenant, how do you navigate when they say, well, I've been doing it this way for 20 years, or put up resistance to the new owner? I haven't had that exact dilemma, but as I told you, inherited tenants, you inherit the problems. So what I have done and changed my business model so I don't have the eviction and people stop paying me is we re-qualify them and say, hey, we're the new landlord of the building. We know you've been here a long time and we would love to keep you. However, we have certain parameters to make sure that our tenants are not only a good fit for the building, but are financially stable enough where it is beneficial for them and beneficial for us. And then rerun through, because now you're restoring that power because you're choosing them. And then if you want to continue having them do the role, you can vet them at that time and make that decision. I do have one that I inherited that did like the lawn service, and we agreed to give them $50 and they actually did a good job. And I made it very clear. I said, hey, we'll do a 30 to 60 day trial run. If I don't like the product that's being given, I'm going to take this back. Your rent is the whole amount. I'm going to cut you the check for $50. That way, if I revoke it, it's not like now their rent increased. I restored the rent to where it was. I always pay people. I never do rent discounts. Any other questions?
All right. So I'm gonna quick take over here for the property management segment. It is a matter of like, do you want to have a property manager? And if you don't, and when you're first starting out, and maybe if you're an owner occupant and you're living there, tax records are public. They are probably going to know that you are the owner. So they're going to probably be knocking on your doors, but it's going to be easier that way. I still manage one of my own properties because they're very easy tenants. They pay on time. I've never had an issue, and they only call me when something is dire. For the most part, they're handy and they fix things themselves. All my other ones, I decided, you know, when I'm working in real estate and I'm having those 70-hour work weeks, 7 days in a row, it was not ideal for me to be managing properties as well. It became too much. So was it worth it to take that off my plate and give it to someone else? Yes. I will say that not all property management companies are the same. I just fired the one that I've had for the longest because their employees turned over and they were horrible. So everything that I had agreed upon up front with the previous manager, like somehow like all communications were lost. They had no idea. And we did have an eviction that did take the 3 months, as I said, and it was kind of a nightmare. And anyways, it was several months. But so interviewing property management companies and actually finding out what they do for you is a great thing. You know, there are companies out there that you're like, I don't want any say. You make all the decisions, you just send me my check. At the end of the month, you do that. That's fine. Then there's other ones where you can put things in place to say, I would like to have some sort of say on if it's going to cost over a certain amount of dollars to fix something. I want to be able to, because I have it where they come in, they do make their money on repairing your units. And sometimes they will overcharge or tell you you need to have things done that really don't need to be done. And that's where they make their money. So having some of those decisions, I also have good contractors in my back pocket that if I see something that they're like, oh, it's going to cost this much, I'm like, yeah, I can get my contractor for 35% less. I'm going to call my guy. But yes, when John, when you were talking about like inheriting somebody who already was doing some of that, I did have that situation. I had a property management company. She drove them nuts that they actually gave the property back to me and said, I no longer wish to manage this property because this tenant was a nightmare. And then I had to find a new company who charged me 4% higher. Everything was higher. She hated that company as well. She somehow got my phone number and blew it up all the time. And I had to have that. And I'm not I'm too much of a nice person that I want to like, okay. But at some point it's like, yeah, I also work. You got to stop. These things are not important. Talk to the management company, submit a claim, whatever it is. But yeah, so I do encourage property management companies because it like takes away, I guess, that personal side and keeping it strictly business where you don't feel so bad. But to John Warren's point earlier is like, yes, I literally have gotten now twice. So like, we should raise the rents to this. And I said, they've been here for this long. That would be such a huge increase that they will leave. And then they've been there for 5 years. What I'm going to have to pay to fix the property back up is going to cost me more in the long run. So I said, no, let's do slow increases to market rents. I don't want to just like jump this because then the fixes later are gonna cost me more money. So all things you're considering. Anything else you want to say about property management? Okay. Any questions on property management? Okay, tax strategies. Here we go.
All right, yes, I'm back, Aaron, A+ Mortgage, to talk about tax strategies. Big disclaimer, as I just said, I work for A+ Mortgage. I don't work for a CPA. I'm not a CPA. So we are not tax, legal, or accounting advisors. My background on why I decided to touch on this is back in 2020 when the world shut down, I got kind of obsessed with this and sat in an 8-hour webinar, then read a few books on it. I can get anybody any additional resources. If you want to look on YouTube, or you want to buy some books on it or audiobooks or whatever, jot down the name Mark Kohler. He's got 7 books. He's got a weekly radio show. He was the 8-hour webinar I was on. He sent me some free resources. I ended up emailing him and he sent me some free resources as well, which basically he specializes as a tax attorney. He's not in Wisconsin, but also works with a lot of, he's also runs a CPA firm. He deals with basically all investors and business owners. So a quick review here of the 4 quadrants I mentioned earlier to start my presentation, because we skipped one of those 4 quadrants. I want you to know those 4 quadrants so good that you can jot it down on the back of a napkin, is what I said earlier. At some point in the next week when you're doing a review with each other or somebody from work or a friend. So again, we had the three that we already went through. We went through cash flow. We went through appreciation. We went through mortgage reduction. We did not go through tax savings. So we're going to dive into that now. We're going to show you after we go through tax savings, how you're going to save. You're going to increase, I should say, your ROI by at least another 3.5%. Just that first year, and it's going to exponentially go up for years to come from there. If we do all of this, the one thing I didn't do is give a year one ROI, but now that we've got our tax savings included, we actually came up with 31% ROI with these 4 quadrants. So the example is the 3 quadrants we went through early in factoring tax in. Again, we used a very safe appreciation number. If appreciation is 5%, which we know it's more recently higher than that, that ROI all in goes actually to 38%. So just something to factor in here. All right, so with tax savings, there's really, think of it in 2 sides of a column here. The left side of the column you see on the screen is active income, which is short-term income. This would be, I'm a W-2 employee. This would be W-2 if you're salaried, if you're hourly. If you were a sole proprietor, generally speaking, I mean, you're going to fall under this. If you're buying fix and flips, so you're doing flip properties, they generally would fall under this. So most people are going to fall under this left side of the quadrant. The right side of the column, the right side of the quadrant is going to be our investments and our long-term rental properties, and even short-term rental properties would fall into this. So let's go into this here. If I'm on the left side, I've got my income, I've got my salary, W-2, whatever I make, however I get paid. I subtract out my taxes. Whatever I make, taxes come out first. Now, let's say I'm paying for gas to get to and from work. Let's say I'm buying a new computer that I need for work. Let's say I'm buying things I need for work for my home office, whatever it is, whatever your scenario might be, that's expenses. That doesn't come out until after I pay my taxes. And after my taxes and expenses are paid, well, that's what's left. Let's go and think, as John mentioned, as the mind of a real estate investor and how this works now on the tax side of things. We've got our income. We get to count our expenses first and taxes come in afterwards. So what does that mean? Well, then what's left? That means I'm paying a lot less taxes. And we're going to show you how in most scenarios, most people I know that own real estate investing don't pay any money on their actual income. They do it completely legally on the rental real estate. So let's go into that. Again, we've got the left side here. We already talked about how a vast majority of us, myself included, for what I do on the day job is on the left side. We've got our passive long-term income on the right side. That includes our long-term rental properties. On the left side, if I'm going to quote Robert Kiyosaki, now again, that's Rich Dad, Poor Dad, amongst many other projects he's done. The only tax break you get to have on this side of the quadrant is to buy a bigger house and go into greater debt. Okay, from a tax standpoint, doesn't sound all that exciting. Let's go on the right side here. On the right side, we talked about the example we used earlier. We used 10% cash flow ROI. We came in that example of $75,000. And we said 10% means year number 1, we're walking with $7,500 in our pocket, not including appreciation, not including the mortgage getting paid for us. Let's talk about that $7,500. Well, if you can't already write off your phone each month, now you get to. Every time I drive to the property, I get to write off mileage. When I went out looking to buy that property, I tracked all of that mileage. I got to write that off. There's countless other things you can write off, but let's go to the big D. And John in the audience here asked about this earlier. Big D, talking about depreciation. This is a huge form of phantom income because I don't know about you right now, but on your W-2 income or however you get paid, most of us are probably paying taxes on our income. With real estate investing, you get to pay nothing in most scenarios. So how? If I bought that $300,000 home, let's go with the example you used earlier. In real estate investing, I get to depreciate that home over 27 and a half years with residential real estate. That means I'm writing off over $10,000 per year. Well, I just mentioned I'm making 7,500 that first year. I'm writing off at least 10, not including my phone, my computer, my mileage, everything else. Some of you are thinking, wait, so you're not making money in the property? Oh, no, I'm making the 7,500, but how taxes are looking at it, I'm making nothing. I get to keep that whole 7,500. I'm paying $0 on my taxes. Pretty awesome strategy. As you accumulate more properties, there's ways to do accumulated depreciation and accelerated depreciation. To go into this faster, that's more of a 201 strategy that we're going to talk about later this year. Little teaser, we're going to have an investment 201 most likely coming later on in 2024. So again, as John mentioned, John Warren earlier, once we sell the home, he gave the example of the guy he bought the home from 30 years later. Yes, now that depreciation is used up, some of the taxes might catch up to you a little bit later, but we already went into what you're now making 20 years from now using very safe numbers. So personally, I'm not as worried about it, but there are some different strategies at that point to kind of restart the process. Many people I know about that use these. One of them is a 1031 exchange. I am not the right person to talk about a 1031 exchange, but basically, I understand it. You're selling that investment or that property. You're taking that chunk of money, it's being held. There's a certain amount of time that you have now purchase another property and that money moves over and you're avoiding capital gains. You're avoiding different taxes on it. That's something on a future session that we're going to have 201. We'll touch on that a little bit more. I'm sorry, what was it?
Deferring, not avoiding.
Deferring. Thank you. Not avoiding, deferring. Very well said. Any questions on the tax side? We kept it fairly basic right now. It can get very, very, very advanced. But any questions on the tax side before we move on here?
Regarding depreciation, do you calculate how many years you should hang on to a property before you remove yourself from it because of the depreciation and the fact that you're deferring money from Uncle Sam? And at a point in time, when you cash out of that building, you have to go back and calculate all that and belly up to the bar with that money.
You are technically correct. Not necessarily the borrower, but from a tax standpoint, it's going to kick in somewhere. We personally don't, being 12 years into it. With the 27 and a half years of depreciation that we have, we've got some time yet. We have utilized some of the accelerated depreciation as well. But that said, if we got to that point, we'd probably do the 1031 exchange and get a lot more well-versed and partner with our partners on that and defer longer, basically sell that property, buy something bigger. Maybe we sell a duplex and buy a 4-unit or something different. And
Because what I would always do is, after holding the building, I look at the accelerated value based on market growth, and obviously property grows in value over years, and I look at the depreciation equation and I'd say, okay, where am I at in regards to, I make an X amount of dollars in profit, depreciation, I have to owe Uncle Sam X amount of dollars. Now the time is to take the weakest racehorse and trade up and get a stud.
absolutely. If you can trade up, you're talking about doing the 1031 exchange.
Yeah, or else you can avoid, recalculate depreciation by taking a property and turning it over to another family member's name, and the depreciation cycle starts all over again.
Yep.
I would say good CPA questions too, to ask, because our CPA did on a home that we lived in and turned it into a rental and said, now you're getting to that year where this is all gonna kick in. And he was like, you should consider selling the property. And I was like, yeah, that's not happening. I'd rather take 20 more years of rent from it, to cover. So yeah, I was gonna say, like, those would be really good CPA questions.
The biggest thing to remember on this right now is whether this is your first rental property that you're going to be potentially buying in the next 6 months to a year or two, or maybe you're buying your second or your third, is in the beginning, I know 12 years ago for us, it was a big step. It was somewhat scary. Yeah, I spoke earlier about all what it could lead to, but in the beginning, we didn't necessarily feel that way. There was a lot of late nights talking about it, building up the courage, doing our research. We didn't necessarily have somebody like this. I had a mentor in Michigan that I personally worked with and knew, but he was new to it. He was just 2 years into it. So he didn't have this vast 10, 12, 15 years of knowledge. But he was talking about some of his mentors. But anyway, in the beginning, you have a lot of tax strategies, excessive tax strategies. I'm not disregarding it, and I'm probably not the very best to talk about it, John, to your question on that, of calculating it. But in the beginning, as you're building up and you want to see your cash flow grow, to what John Warren spoke about earlier, as you want to see your wealth grow and your net worth grow with the appreciation and mortgage reduction, you have a lot of years in the beginning in your favor. And the way I look at it is when it gets to that point that we are eventually gonna have to pay more in taxes on it, to me, it's a good problem to have. It means we've gotten to that point where we've got more coming in. We've grown, we've appreciated, and we've exhausted and didn't have to pay taxes along the way. That's maybe it's not the best way to look at it, but I feel it's a very good way, especially as you're growing and building and getting started in this. Any questions online, Brian? No. I'm gonna turn it over to Tanya here. I don't think Tanya needs an introduction.
Okay, just a few, let me get in the right spot. There we go. Okay. A few things on how a realtor can help you get started in the process. One, obviously locating the properties for you, not just on market properties, but we have access to a lot of off market properties. We're out meeting with people that at some point, may want to sell their house. They don't want to put any work into it. Could be a perfect investment property. So we have a big team. We've got 10, maybe someday 11 agents on our team, and and we share with each other. What do you have out there? What's coming up? We network with other realtors in the area, so we can find some of those off-market properties for you. We can help you negotiate the contracts, make sure that everything is right in line, so everything closes accurately. We can recommend contractors, as Miranda mentioned. We have a lot of contacts with contractors. We can determine rental amounts for you. John was talking a lot about that. So we have access to be able to pull rental ranges for you. We can update property valuations for you. So if you're thinking, maybe I have equity in this property and I want to try to get a HELOC, we can run numbers for you and let you know what it looks like without you having to pay an appraiser. And then someone on our Saturday session already asked ahead of time, what about preparing, what if you're going to sell one of your rental properties? We can definitely help you, give you guidance in how to prepare it for sale, because you don't want to over improve it depending on who you're looking at as your target buyer, right? So we can help you with all of that. Aaron also alluded to the fact that we are later this year going to be having Investment 201, where we will talk those 1031 exchanges. Will have an intermediary come in and explain the whole process, what they do. Our favorite tax CPA, who's very knowledgeable, is really busy, so we're looking for a backup to bring in, but we'll let you all know when that's going to happen. We do want to offer, though, if you have more questions that you just didn't feel comfortable asking here, please, we would love to have you book a one-on-one private session with any of us that are here today. We're going to send those of you who are on Zoom, we will email you a survey and just some feedback on what you thought of this seminar, and then also a spot where you can go ahead and request your one-on-one consultation. And then we've got hard copies for everyone here. Any other questions? Anything we didn't cover that you wish we would have that we could tap into right now? Anyone online? All right. Well, thank you all again for joining us. I hope you took away something of value, and maybe we'll see you at 201. Bye.